Good morning, everybody. This is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, October 26, 2024. Hey, I hope you're doing well. I appreciate you coming and watching my weekend review podcast. I hope it's going to be helpful for you, and I hope you had a good week of trading. So, all right, this is going to be the format for today's podcast. First of all, we're going to run the U.S. legal disclaimer, get that out of the way. Secondly, we are going to come back. We're going to take a look at all the trades and positions that I made and I am in from last week. We are going to talk about when I entered the trade. We're going to talk about why I entered the trade. What were the signals? What were the confluence of signals? What was the decision and the triggers that got me into the trade, and then how I am going to format this trade, meaning how I position size correctly based upon volatility, how I'm going to place my two stops, my end of bar stop, and my emergency stop, how I'm going to take partial profits if the trade starts to go in the direction that I want it to. And then if and when it gets to significant overhead resistance levels, how I am going to handle that as well. So I hope that's going to be helpful, give you a little bit of an idea of my process and my thinking of how I manage trades. We'll talk about when I entered the trade, why I entered the trade, and how I am going to manage the trade going forward, which is really the most important in trading. In my opinion, it's very important to have a plan. It's very important to have a process. If then statements, if it does this, then I'm going to do that. If it does that, then I'm going to do this. It's really important to create a very precise plan before you get into the position, and then obviously follow that plan once it starts to happen. Overall, you'll be just a much better trader, everyone, if you have a process, if you have a plan, and you follow it. And I understand that following the plan sometimes is difficult, but you need to look at you need to be very disciplined. You need to look at like this as a business, because a lot of trades, I don't care how good they are, how good the setups are, doesn't mean they're going to be winners. You're going to take losses all the time. The most important part, though, is that you try to keep those losses small, and get out quickly when you're wrong, and then have a process, have a plan that keeps you in a winning trade. So, two things I always say. One, be very impatient with your losers, be very patient with your winners, and get out of losers quickly, and stay in winners as long as they're doing what they need to do. That's the important thing. Most people do the opposite. Once they have a winning trade, they want to hurry and get out of it because it feels good to take that profit, which is really not the right thing to do. You need to be able to risk open profits to make more open profits, and then if a lot of traders, if it goes against them, they always put they put their rosy glasses on and say, oh, it's okay, it'll come back, it'll come back. Well, a lot of times it does, but there's some times where it really just can destroy your account, really. So we'll go over all the trades, what I'm doing with them. After that, we are going to talk a little bit about trader psychology. Always most important skill in trading, everyone, is the ability, like I just mentioned, to create a plan and follow the plan. And so that all comes down to psychology, so I like to talk about that. Always helps me to teach it, and I hope it helps you to hear it as well. And then after that, I have gone down through my master watch list. I do that every Friday night, and I've gone down both on the daily time frames and the weekly time frames, and I've identified some potential trades next week that I'm looking for. Now, they're not where they're supposed to be yet, because if they were, I probably would have already taken them. They're not where they need to be, but in my opinion, one of the best things you can do in trading that I've done over the years is exactly what I just told you. Look on the weekends for the coming week, look at a symbol, look at a stock, look at a market, and say, boy, if it got down there, then there's all sorts of confluences, there's all sorts of levels, and that would be probably a pretty good place to get in, like maybe a deep dip buy with a 200-day moving average, a 250-day moving average, a 300-day moving average, in addition to maybe some bullish order blocks, in addition to like maybe a 30 RSI, something like that. I'll show you a trade in a minute on UNG where I did that, I waited weeks and weeks and weeks for it to get where I thought that would be the right place. And it was exactly the right place. But, sitting on your hands, waiting for a market to get to the levels that you want does not guarantee that you're going to have a profitable trade there, but it will improve your chances. And we need to do everything in trading to improve our chances. So I've gone down both on the daily time frames, the weekly time frames, identified some potential trades for next week that I am definitely considering. So hopefully that will give you an idea of how I just like to sit and wait and go, okay, come to where I want it to get into. Don't just take it where it's at because it's not at a level, or it's not in a location that makes any sense. But just be patient. Wait for the trade to get to your level. Some of them will never get there. They'll turn right back around, go up, and that's okay. But some will always get there. I promise you that. Some will always get to where you want. And then you just have to decide, if you're going to pull the trigger on it or not. And then if you do, of course, do all the things that we're going to talk about: the position sizing correctly, place your stops, know what to do, whether it goes up or down. All right. So I hope today's podcast is going to be helpful. If it is, and you find some value in it at any point in the podcast, I really would appreciate it if you would hit the thumbs up button. It does really help the channel. Lets YouTube know that there's some valuable content here, and keeps the channel around. So I would really appreciate that. And if you haven't subscribed, please subscribe. I always forget to mention that, but I'm getting better at it. So, hit the like button, subscribe if you like the content. If not, then don't. All right. All right. Well, let's get this U.S. legal disclaimer out of the way, and then we'll get started. Hang tight.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right, let's get started with the current open positions. This is Pfizer. Man, this one's been kind of a wild one, as you can see from the charts. But I guess what I'm saying is that I like to take partial profits along the way, and I have trailing stop levels and so forth, which really made a difference in this trade. So it's a good example of some of the methods that I use and why I use them. So, okay, I did get into Pfizer back here on the 12th of September. Why? Well, this is what is called a bullish fair value gap, and the fair value gap is in this green area here. So the reason I took this trade was we have these lows over here. We have these lows over here. This big bar here on the 9th of September, this big strong bar up here, took out these previous highs and changed the structure of this market, Pfizer, from a bearish market structure into a bullish market structure. And when you change from a bearish structure to a bullish structure, what I like to do is buy the dips. All right, so you can see the dip there's 3 bars here, one here on the 6th, one on the 7th, one on the 8th. The fair value gap, the bullish fair value gap, is the high of bar 1 and the low of bar 3. That's where you get this green box here. So when you change structure to the upside and it comes back down into the green area, into the bullish fair value gap, that is where I like to buy. So it did come down, and I did enter here on the 12th at 28.85 when it came down right to the bottom of the fair value gap. Now, whether it's a fair value gap or any other strategy that I use, and I use 7 of them, I always position size the same way. And it's very important that you position size based upon your account value and what the current volatility is in the market. So I got in at 28.85, but the question is how many shares do you buy? Well, the way that I do it is I take 1% of my total capital divided by the value of the 2 ATR. So let's just say it's a $100,000 account. 1% of that is $1,000. I divide it by the value of the 2 ATR at the time on the day of the trade, $1.06 divided by $1.06. That tells me to buy exactly 943 shares. Uh-oh, what happened here? Okay. 943 shares. So that is the correct amount, the way that I trade, the amount of shares to buy based upon the account value and the volatility of the market. And the 2 ATR is what I use to figure all that out. So as soon as I buy, I immediately want to put in my emergency stop. Well, my emergency stop is exactly $1.06, whatever the 2 ATR was that you used in your formula, and place that all the way down here, $1.06 below entry. So that means if I have 943 shares and it goes all the way down to my emergency stop, I've lost that $1,000. Okay. The good news is that only happens about 5% of the time. 95% of the time, if you have a losing trade, it will be because of your end of bar stop. Well, on a bullish fair value gap, when I enter a bullish fair value gap, I look for the closest swing low, and the closest swing low was down here at 28.28. So if in the future it closes below here, then I'm out of the trade. If it ever gets to my emergency stop, I'm out immediately. But on the end of bar stop, I wait for a close below, and I'll show you in a minute why the close was important. So I identified that we changed structure to the upside. We came back down at the bottom part of the fair value gap. I got long 28.85, position size correctly, placed my emergency stop 2 ATRs below. My end of our stops closed below this swing low. Now, the next thing I do is I look for my 1.5 ATR reading. Right now, the 1.5 ATR reading is 79 cents. So I take my entry price and add 1.5 ATRs. All that means is if I get to that level after I've entered the trade, if I get to that level, now I go into what is called trailing stop mode. And what that means is that then if I get to trailing stop mode in the future, if I have a close below a previous bar's low, I'm going to get out of half. Okay, so entered 28.85. Now, last thing I want to go over, and I'm spending a little bit more time on this one because it's the first trade, but everything I've talked about so far, the position sizing correctly, the end of bar stops, the emergency stops, trailing stop levels, these are all rules that I have for if something goes against me. So it's all defensive, and it's very important to be defensive. But in trading, in my opinion, you also want to play some offense as well. And the way I play offense is I sell a portion of my position into strength. And the way that I determine that is that I always take profits, partial profits, 10% profits, if the net if the market that I'm trading moves up the value of 0.45 ATRs from the previous bar's close. So let's just go ahead in real time here. I look at the closing price of the market right now. Pfizer's 28.45. So I take the closing price, I add the value of whatever the 0.45 is at the moment, and right now it's 24 cents. So I take 28.45 plus 24 cents. For Monday only, my first profit target is going to be at 28.69. Then, because that's the first profit target. Then I take 28.69, I add the 0.45 to it again. So I add the 24 cents to it again. My second profit target on Monday is 28.93, and then I do it one more time. And the third profit target is 29.33. So I always have 3 profit targets for the next day. So if it moves up the value of 0.45 ATRs, I'm going to take off 10% of however many shares I have at the moment. Okay, so we had a structure break to the upside. We had a fair value gap. We came back down low into the fair value gap. I got long 28.85. I position size correctly. I placed my emergency stop 2 ATRs below. I have my end of bar stop here at the bottom of the swing low. Next day, it didn't do anything. Didn't go up. Not enough for me to take my partial profits. But the next day, boom, had a big day up. I did hit several profit targets on this big move up. So I think I hit 2, I may have hit 3, I can't remember. But I took off at least 20% of the trade in these profitable areas, which is important, especially based upon what the stock's done from here. Now, on that particular day, not only did I hit some partial profits, but I also got the trailing stop level, the 1.5 ATRs above. So when I get here, it doesn't mean I do anything. It just means now I am in that mode, which means in the future, if I have a close below a previous bar's low, I'm going to get out of half. So the next day was down a little bit. I didn't do anything. The next day was down a little bit. Didn't do anything. The next day, it gapped open, went much higher, which was nice because I hit again. I took off partial profits into this big move up, which, based upon where it is now, was a really good idea. So again, I always like to take something when the market gives it to me. Then at the end of the day, we closed below the previous bar's low. Well, I'm in trailing stop mode and we close below a previous bar's low. What do? I take off half of however many shares I have remaining. So I took off half for a gain of 2.73%, which then we just went straight down. And of course, I'm glad I took the profits when I had them here and when I had them here. And then I took off half of what I had remaining here because we closed below previous bar's low for a gain of 2.73%. Then we move down, move down, move down. Remember, this is my swing low here, the 28.28. If I have a close below there, I'm getting out. Well, we got almost to there, but we closed above. And then twice down here, we went under, but we closed above, went under, closed above, and that kept me in the trade. Then we moved up here, took some profits, had another huge bar up here. Again, I took more profits off, which is very important. We moved down. Then we had one more huge bar up here where I took 3 profit targets off. So you can see taking profits, trailing stop mode profit, and then we went down, we went up here, took some more profits, and now we've just gone straight down, and it's not looking too good. But I'm still profitable on the trade, even though we are under where I entered the trade because of taking the partial profits and the rules that I have. So when you have a really choppy, sloppy market like this, boy, I feel very happy and that I've taken profits when I had them. Now, the current remaining shares that I have on this trade are down 1.41%. But again, I'm not really down because of taking the partial profits. Now, we have earnings on the 29th. So Monday or Tuesday or before earnings, if we close below this low, well, that's my end of our stop. I'm simply out. But even if we head back up from here, if we head back up, yes, I'll take partial profits, so forth, but I will exit before earnings. I never hold through earnings. So anyway, this is kind of a wild trade, but it's a good example of why, in some cases, taking those partial profits really helps. So the remaining shares here on Pfizer down 1.41%, and I am getting out before earnings. Okay. We'll be a little quicker on these. So FedEx, I did enter FedEx FDX on the 15th of October. Why? Well, this is a deep dip buy. This is another one of the strategies that I use. And a deep dip buy uses the 200-day moving average, the 250-day moving average, the 300-day moving average, or the 30 RSI. So on the 13th, we were below the 200-day moving average. On the 14th, we closed above, but I did not buy it here. I could have, totally legit. But the next day, we went higher and then we closed lower and we closed right barely above the 200-day moving average. Well, this is a legitimate buy because it's a good risk to reward ratio because it's so close to the 200-day moving average. So I entered here 266.40, position size correctly, placed my emergency stop 2 ATRs below. My end of bar stop is simply a close below that 200-day moving average, below that black line. So, I talk about risk to reward a little bit. Is this a good risk to reward? Well, it is, because even if the next day it just closed below the 200-day moving average by 1 penny, I'd simply be out. So that's the key. Look for important levels that hold. Then I enter the trade, and then if those levels are not strong enough to hold, I simply get out. I mean, if the next day it goes back up, I could just simply get in, but that's my line in the sand. Okay, so I entered here 266.40, emergency stop 2 ATRs below. My end of bar stop closed below the 200-day moving average. I placed my 1.5 ATR trailing stop level above, and then if it moves up, then I take partial profits. Well, the next day it did move up. Boom. So I took some profits. The next day it moved up, not enough for me to take profits. Then we moved down. I didn't do anything because we didn't get to trailing stop level yet. On Thursday, we had a huge gap up where I took multiple profit targets off right at the open. And then on Friday, we were down a little bit. But the key now is that we are in trailing stop mode because we got to that 1.5. So Monday, if we close below a previous bar's low, what am I going to do? I'm going to take half because we had a close below a previous bar's low after reaching trailing stop level. But it was nice to take those multiple profit targets right off at the open on Thursday. So far, not a bad trade, up 2.07%. But the key here was the entrance was the really good risk to reward ratio. I mean, I'm basically at my line. So if it just closed below, I would be out. So this is a deep dip buy. This one up 2.07%. UNG. Okay, so you can see the green area here. This is what I was waiting for. I was waiting for the price to come down into this green area. What is this green area? This green area is what is called a bullish order block. A bullish order block is your lowest close before market structure change. And so if it ever gets back down to that area, that's generally where it will bounce. Not all the time, obviously. And if you've been watching the podcast for the last couple weeks or so, I started talking about this area way up here. I was like, if it gets there, that's where I want to buy it. But it wasn't even close, right? And then last week it was getting closer, and I said, okay, we're getting closer. If it gets down into that area, that's where I'm going to consider buying. And in addition to being in this bullish order block, the key was this bar back here on the 29th. See the big up bar? Well, if you have a big up bar and it ever comes back down to about halfway of that big up bar, there's going to be some inherent support there. So the confluence of this trade was, one, that we came down into the bullish order block. I was patient and waited for it to get there. And besides the order block, we came to halfway of this big bar. And look at that. I mean, it went a few cents under, but nailed it, just nailed it. And I drew the little green or the little blue box inside the green box because I said that is the spot where it has the best chance to bounce. And almost within pennies, it bounced. So I did get long here, 1303. Of course, I placed my emergency stop 2 ATRs below, as always. My end of bar stops a close below these lows here. And then my 1.5 ATR trailing stop level, 1.5 ATRs above. Next day, it moved up a little, not much, no profit targets. Next day, moved up, enough for me to take profit targets. Next day, moved up, enough for me to take profit targets. Thursday, moved up, more profit targets. Friday moved up, but no profit target. So I am in trailing stop mode, which means that if I have a close below previous bar's low, I'll get out of half. If it continues up, I will continue to take profits. Currently, this has been a great trade. It's gone straight up 9.9% in 1, 2, 3, 4, 5 days. So almost 2% a day. That's been a really good trade. But if, like I said, if it continues to move up, I will continue to take partial profits. We're at a 49.96 RSI. If we get to the area where we get to a 65 RSI level, then I have other rules that come into play where we will start to use the 5 EMA as a trailing stop level. Also, another important level above would be a 70 RSI. I have rules for that. I have rules for everything, everyone. I've been trading for over 29 years now, and you have to have a plan for whatever happens. And so I have many rules, and those rules are there for a reason. On all the different strategies that I use and I teach, I have rules, but every rule is not there just to have a rule. It is there for an exact reason. And I'll just mention right here, I do teach private one-on-one lessons in the evening time via Skype. I teach my students all 7 of the different trading approaches that I use, step by step, how to trade each one, how to have the rules. I've taught people from all over the world, from beginners all the way up to the hedge fund levels. I love to teach. I love to see my students learn and be able to learn a skill that they can use. So if you're interested, like I said, it's one-on-one, so it's just you and I. We do 5 sessions. Each session's 3 hours, so it's a 15-hour course. You're going to learn a lot. You're going to be glad that you took the course. You're going to walk away with it, with the skill. So if you're interested, my email is in the link of this YouTube video. Just reach out to me. I know you're going to be glad that you took the course and really learn how to trade. And this may seem, if you're new to the channel, this may seem like, man, he has a lot of rules. How would you ever learn this? It's easy. It really is. Okay, so back to UNG. Really great trade. Waited, was patient for the confluence of the order block and the halfway of that bar, and we just about nailed it. And so up 9.9%. Microsoft. Okay, Microsoft is a deep dip buy based upon the 200-day moving average. I was really looking for this area down here on the podcast, 406.63, but I said, if it comes down to this area, that would be my preference, unless we go back over the 200-day moving average, which is also a legitimate deep dip buy. But see how we were over and under and over and under. It started to lose respect for the 200-day moving average. So I said, if it moves back over the 200, I definitely would consider getting long, but it has to be the right price action, and the price action was correct. So I got long here. Oh, geez. Right. Yeah, it's right here at the close, obviously. When we had an intraday rejection of the 200-day moving average. So that's the black line. During the day, we went below it, but we then closed above it, giving me a very good risk to reward ratio. In addition to just the intraday rejection of the 200-day moving average, we also had something that is called a V1, which added bonus points to the quality score of the trade. A V1 consists of 2 bars, bar 1, bar 2. Bar 2 goes below bar 1's low, closes above bar 1's close. So that was the confluence of the trade. Intraday rejection of the 200-day moving average and the V1. And by the way, if you want to learn more about V1s or V2s, I use these. They're kind of my bread and butter in my trading. Just go to my YouTube channel, look in the lessons playlist, look for V1s and V2s. So got long here at 418.80. Emergency stop 2 ATRs below, end of bar stop, just simply a close below the 200. That's it. If the next day it had just closed below the 200, I simply would have got out for a small loss. But thankfully, the next day it just took on off, and I hit multiple profit targets on this big move up, right? So I started reducing my position into this strength, also at trailing stop. Now it just means if I have a close below previous bar's low, I'm going to get out. We went down, but we never closed below. On Friday, we gapped up, went up, took more profits into that strength, right? With the limit orders that I have in the trade, and then it sold off a bit, but I did lock some profits in here. So this position doing very well. I am in trailing stop mode. This position up 2.18%. We do have earnings coming up on the 30th of October. Again, I'm not going to hold through earnings. I will exit before, but this one up 2.18% on this combination intraday rejection of the 200-day moving average and the V1. Let's go to Rio. Okay, Rio. So let's talk a little bit about abandoned babies and island reversals. Island reversals consist of 2 or more bars. Abandoned babies consist of 1 bar. Oh no, I'm sorry. I took this with a different. I was thinking of a different trade, and I just highlighted here that there was an island reversal. Okay, this was strictly a intraday rejection of the 200-day moving average. And if you remember, I was talking about Rio coming down and simply rejecting the 200-day moving average, which it did. But I like confluences, and the confluence was this. I talk about when the gray line crosses over the black line. That's called a golden cross. That's when the 50 SMA closes above the 200-day SMA. And when that happens, usually the first move back to the 200-day moving average is a good place to buy, because not only do you have a rejection of the 200, you have the golden cross preceding it. So I did get long on Wednesday at 64.49. I position size correctly. I placed my emergency stop 2 ATRs below, my end of bar stops a close below the 200-day moving average, my 1.5 ATR trailing stop level up here. Now, the reason that I drew the green box here is because now we have what's called an island reversal. You see how on the 22nd, we gapped down. So whatever reason, the sentiment at the open was negative. It gapped down. Then we moved sideways on Thursday, and then Friday we gapped up. So it leaves these 2 bars here, gap down, sideways, gap up. This is called an island reversal. So I didn't take the trade because of the island reversal, because it had not happened yet, but it fortifies the position. It adds points to the position now that we have an island reversal. This is an island reversal up here in the red. Look, we gap up, we go sideways, 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 and then we gap down. That's bearish. And look at that. That island reversal, it nailed it. So this is a bearish one. This is a bullish one. I did not set up the trade based upon an island reversal. I set it up based upon just a rejection of the 200, but I'm glad that it formed the island reversal because, like I said, it helps the trade. So this particular trade doing okay. I mean, it's positive a little bit, up 1.18%. Okay, IEF. All right, well, this one barely kept me in the trade, but this is a really good setup. It doesn't mean it's going to work, but it's a really good setup. I got long IEF, which are basically the 7 to 10 year treasury bonds. I got long here 95.10. I'm down on the trade so far, but it was a great setup, and the setup was as follows. We had an under 30 RSI over 30 RSI. This is a deep dip buy. Just that by itself is a legitimate signal, but I like confluences. The other confluences, we went from under the 200-day moving average over the 200-day moving average. One of the strongest deep dip buys you can get is when you have an under 30 over 30 and an under over a moving average like the 250, 200, or 300. In addition to that, we also had a abandoned baby. Abandoned baby always consists of 1. Look, we gapped down. Next day, gapped up. And we had a V2. Bar 1, bar 2, bar 3. Bar 2 goes under bar 1's low. Bar 3 closes above bar 1's close. This is, if we had a double bottom bullish divergence or something in here, it would make the trade better. But lots of confluences of signals here. under 30, over 30, under 200, over 200, V2, and a bullish abandoned baby. So I got long here, 95.10, placed my emergency stop 2 ATRs below. My end of bar stop is simply a close below the 200. Look, it almost closed below the 200 on Friday. The 200 is 94.88. It closed at 94.89. It kept me in by 1 penny. Had it closed under, I simply would have got out, right? Just in, out, it's fine. That's good trading. If you get in, very next day you get out, too bad you had a little bit of a loss, but that's correct trading. A lot of my trades, I'm in one day, out one day, out the very next day. In one day, 2-3 days, I'm out because I'm very impatient with my losers. However, if this starts moving up, I could be in this trade for 8 days, 9 days, a month, right? So that's the key. Be very patient with your winners, be very impatient with your losers. So good example of a good risk to reward ratio. If it closed below the 200, had it closed below the 200 on Friday, I simply would have been out. That would have been it. Taken a small loss. I can always get back out. But this is a great example of a great confluence. Under 200, over 200. Under 30, over 30. V2, bullish abandoned baby. But even with all that, it may not be a profitable trade. You never know. That's why it's important to position size correctly. So this one is down at the moment, not much, 0.23%. And going forward, if it closes below the 200, I'm just out. I can always get back in if it goes back above the 200. But good example of a really good, high quality, AAA rated trade. That's down a little bit at the moment. All right. I did get short UUP. That is the dollar. Why did I get short? Well, this is an abandoned baby. Look back here. See the red box? The day before, we gapped up. So sentiment was positive. But after gapping up, we immediately gapped back down. That is called a bearish abandoned baby. That's why it's circled in red. Now, I didn't get short on Thursday. I could have. It would have been legitimate. But what I've noticed on these abandoned babies is once they form, a lot of the time you'll go back up a little bit before you head back down. And so on Friday, I got short when it closed the gap and got back to the bottom of the abandoned baby. I got short at 29.28. So I handle these abandoned babies and island reversals a little bit differently than the rest of my other strategies. It's very simple. I position size correctly. I'm short this trade, so I position size correctly. I place a 2 ATR stop above me, and I place a 4 ATR profit target below me. And I set it, and it's done. One of two things is going to happen. I'm either going to hit my 2 ATR stop, or I'm going to hit my 4 ATR profit target. So it's a good risk to reward. I'm risking 2 to make 4. But in my experience, these abandoned babies, these island reversals, and in my personal experience, about 70% of the time, I hit my 4 ATR profit target. 30% of the time, I hit my 2 ATR stop loss. And I hit plenty of them. But on these particular trades, all I have to do is hit one profit target, and then I can have 2 stop losses, and I'm even. But so it was 50-50 that's what would happen. But this is 70% of the time, I tend to make twice as much as when I lose. And that's what's important. So I was very patient on this, waiting for this trade. We'll see what happens. But again, got short here, 29.28, because of the bearish abandoned baby. I'm either going to hit a 2 ATR profit target or a 4 ATR stop. So I just set it and forget it. One of those two things is definitely going to happen. And I'm exactly even on the trade because I just got in on Friday. Okay, let's get to so these are all the open trades. Let's get to the closed trades. I did get out of Boeing, and I entered Boeing back here on the 14th of October. Why? Well, there's this long-term channel trend line here. Here, I'll zoom out a little bit more. See this long-term channel? I'm connecting the lows here. Goes all the way down here. So I got long on the 14th when we went, uh, the previous bar, we went under 30, then over 30. I didn't grab it then. I waited for it to pull back, test that trend line again, and then close back above. And in addition to that, we have what's called the double bottom bullish divergence. And again, this is something I teach in my one-on-one course as well. But look at these bottoms here. Look how deep these red bars are. These red bars are MACD. It measures momentum. So we go lower, lower, we have a little rally, we get some green MACD, then we go lower. Look here, we're obviously lower here than we are here, but look, there's no red bars. This is called a double bottom bullish divergence with the missing right shoulder. I learned this from studying one-on-one with Dr. Alexander Elder. All this means is that even though we've made a lower low, the MACD bars, the momentum is saying that the selling momentum is waning even though we're lower. And this just implies that you're running out of selling momentum. You're running out of sellers. The implication is that it is going to rally. And that's exactly what it did. So we had the double bottom bullish divergence in place. We went below the trend line, closed above the trend line, came back, tested the trend line, and closed back above. So that was my entry, 148.90. My emergency stop, of course, is 2 ATRs below. My end of bar stop would simply be a close back below that trend line. That's it. Placed my emergency stop, my trailing stop level up here. Next day, moved up, took some profits. Next day, moved up, took some profits. Got to trailing stop level. Then we had a big move up here where I took multiple profit targets in, and then I exited here. I exited here on the 22nd. Why? Because the next day was earnings, and I didn't want to hold through earnings. So regardless of where I am in a trade, whether I'm up, down, but if I'm still in a trade and earnings come, I get out. So I did get out here. Looks like that was the right idea, and pretty decent trade, up 6.82%. All right. So I am out of that, and then a lot of positions here. My apologies, but anyway, gives us a wide variety of things. Okay, so I did get long. Oh, right. I did get long here. TLT. This was a losing trade. This is 2 ATR stop, 4 ATR profit target. Well, I hit my 2 ATR stop on this one. So here, this highlighted green bar, we gapped down, then we gapped up. This is a bullish abandoned baby. I didn't buy it here. I waited for it to come down, close the gap. I did get long 93.76. I placed 4 ATR profit target above, 2 ATR profit target below, and unfortunately on Wednesday it didn't hold and it did go down. And so I did have a losing trade on this one of 2.11%. Okay, so I think that's all of them. Real quick, Pfizer currently in the position down 1.41. FedEx long up 2.07. UNG long up 9.9. Microsoft long up 2.18. Rio long up 1.18. IEF long down 0.23%. UUP even. And then the closed trades, Boeing got out long up 6.82%. And TLT down 2.11%. So not always winners, but there's more winners that are up more than the losers, and that's what's important. Okay, so those are the daily trades. Let's head over to the weekly trades. Weekly trades. Disney, still in Disney. I got long Disney here on the weekly bars. These close on Friday. I got long back here on the 9th of August, so I've been in this trade for a while. What does that mean? If I'm in the trade for a while, it probably means it's a profitable trade, right? Deep dip buy under 30, over 30, got long 85.90. Always place my emergency stop. My end of bar stop is simply a close below 82.95. Placed my 1.5 ATR trailing stop level above. Next week, moved up enough for me to take some profits. Had a few weeks where it didn't do anything. This week here on the 19th, moved up, took some profits. Next moved up, took some profits. Now I'm in trailing stop mode, which just means if I have a close below previous bar's low, I'm going to get out of half. And it's just kind of been hanging around here, didn't close below previous bar's low, so I am still in the trade. Earnings are here on the 14th of November. I will get out before that, but currently the position is up 9.49% on the weekly. And then last but not least, QLD. Boy, this has been a strange trade. You can see there's a red box here. This is a bearish order block. All this means was you had your highest up bar close before market structure change, and if you go from a bullish market structure to a bearish market structure, I like to short when it gets back into that fair value gap. And I did get short here at $100.20 back here on the 27th of September because it got to halfway at this big down bar, and it's also in the order block, the bearish order block. My stop is simply a close above 103.12 next week. I mean, it's just gone up, but it's tested this level, my stop level, 3 times on the 11th, 18th, and then again this week. So I need a close above 103.12 to get me out of the trade, and every time it's got there, it's tried to go above, close below, went above, close below, went above, close below, barely. I mean, look, it's 103.12. My stop is 103. It's 103.5. My stop is 103.12, so it kept me in the trade. Okay, this one is down 2.89%. All right, so the weeklies, the current weekly opens Disney up 9.49%. The QLD short down 2.8%. Okay, so those are a lot of positions there. Sorry, I know it took a long time, but I think it's a good idea to see all the different types of trades and different types of strategies. Hopefully that was helpful for you. So, okay, before we get on to the trades I'm looking at for next week, let's talk a little bit about trader psychology. All right, this comes from Paul Singer, very experienced and famous trader. This is very simple and to the point, but it's fine to be simple because it's so important. You have to be in risk management mode all the time. Folks, let me just tell you, I've traded for over 29 years. If you focus on making money, just strangely enough, you are going to lose money. If you focus on protecting your money at all times, every second, magically you make money as long as you have a good process and you stick to it. I just want to, convey this idea how important it is. When you look at trading as always being on the defensive and getting out quickly when you're wrong. If it moves your way, great. Have a process and just stick with it. But first and foremost, think about protecting your money. Don't think about making money. You have to be in risk management mode all the time. You're going to have many trades. You don't have to bet your lifestyle or all your money on one particular trade. Just get out when you're wrong. Get out quickly when you're wrong. You can always get back in. And then if that new trade is moving your way, stick with it. I know you want to take those profits, but stick with it because I've had some gains, some just huge gains. I think I made like 54% on a UNG short, and it's just because I followed my process. I didn't know it was going to happen, but sometimes you'll have outsized gains, and if you don't have a process that keeps you in there, you're just not going to get those big gains. I mean, I would have got out, if it were up to me, I would have got out when it was up 3.5%. Oh, that's good, right? But that's why it's important, everybody. Let those winners run. Get out quickly when you're wrong. You have to be in risk management mode all the time. Simple, to the point, but, read this and do it. Just do it. One particular trade doesn't matter. It's what you do over time. Just get rid of those losers quickly. All right? And be in that risk management mode all the time. All right, let's get to the potential trades for next week. Now, I always start this off by saying, okay, look, I've got 10 symbols here on the dailies for next week that I'm interested in. Hypothetically, they could all trigger on the same day. Does that mean I would take all 10 trades? Absolutely not. The way that I do it is I narrow it down to the very best trade of the day. All 10 of these could be legitimate, but one of them is going to be better than the rest. And how is that going to happen? Well, I give the trade a quality score. So if it has one signal, I give it 1 point. If it has two signals, I give it another point, so forth and so on. Which one has the most signals? Which one has the best risk to reward ratio? Which one looks the best on a higher time frame? Which one is stronger or weaker than the rest of the market? That also gives you a clue. A lot of times that's the tiebreaker. So I like to give a quality score, I give a report card to the trade, and I just pick the best one of the day. I rarely take more than one trade per day. And again, in my one-on-one course, this is what I teach my students: how to add up these scores, how to pick the best one. The devil's in the details, everyone, when it comes to trading. And if we had a chart of 10 different trades and one of them had the best quality score, if you looked over time how the one with the best quality score did compared to the rest, they wouldn't all be winners. But I would bet you that the one with the highest quality score in the long run is always going to outperform the other one. So 10 different potential trades here. I'm only going to take the best one of the day. So let's go with Boeing. Okay, so I'm out of Boeing now. We went over this trade. I got out before earnings up here, 159.89. But there is another very interesting area down here. Actually, right where I bought it. Here is the green box. The green box is a bullish order block. Again, I teach these in my one-on-one, but this is a bullish order block. Why? Because this is the lowest low close before market structure change. We changed the market structure up here. So now if it comes back down into this green order box somewhere between 149.11 and 146.26, this would be the area that I would want to get into the trade again. Again, the lowest bar close here on the 10th, then we change market structure here on the 21st, we change market structure to the upside. So if you have a change market structure to the upside, you want to buy the dips. And this is the area that I want to buy the dips if we get back down into the green box, if we get back down into the bullish order block. Now, it could just go to the order block, bounce off of it, and close back above. That would get me interested. Maybe we have a V1 or a V2 in the middle of the box. That would potentially get me into the trade. Maybe we would go down, test the low of the order block, close back above. That would also be a possibility as well. But that the Boeing trade that I had was very, very nice, and it did hold down here. More than likely, it will hold here again. So that's what I'm looking for, potential on Boeing next week, somewhere between 149.11 and 146.26 is what I'm looking for. MACD's green. We had this big move up. We had some earnings. They have some issues. But again, this is what I'm looking for, and I think it would be a pretty good trade for me. IBB. All right, IBB is the iShares NASDAQ Biotechnology. This one's pretty simple. Here in the green box, we have the 200-day moving average. In addition to that, the confluences, we have the negative third ATR channel. Negative third ATR channel, 92% of prices tend to stop going down when they get to the negative third ATR channel. And notice we are the 200-day moving average and the negative third ATR channel are dovetailing right here together. That's the confluence. What's it at? 138.87 is the 200. We're at 141.51. It's not there yet. It may not get there, right? But I don't want to buy it here. There's no signal here. The 200-day moving average will help me structure the trade. In addition to that, look at this low here, how deep the red MACD bars were. Obviously lower here, MACD bars are not quite as deep. So there's a bit of a double bottom bullish divergence as well. So again, the key is me looking at this chart and going, this is what I like right here if it gets there. If it gets there, great. Then I'll consider taking the trade. If it doesn't get there, I'll just let it go. So one thing I wanted to mention here too, you see this red box here. So this is a good example of a bearish order block. Highest up bar close before market structure change. When it comes back into the red, probably a good place to short. Was it? It sure was. And it came back down. We got to the red again. Was it a good place to short? Yes, it was. So just a good example of these order blocks that are very, very, very strong. So again, so on IBB, I'm looking for some kind of rejection next week of the 200-day moving average. INDA, wow. You know, this thing never seemed to ever go down. I mean, look, just up, 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 up. Well, now, a little different story. We are coming into some reasonable areas here. 200-day moving average all the way down here, 53.96. I don't know if it's going to get there. It may not get there. But if it does, I would consider buying it down here for sure. It gives me a very good risk to reward ratio and is extremely sold off. Another option of getting into INDA would be a bullish abandoned baby. We gap down from Thursday to Friday. Monday, if we were to gap up, that might be a bullish abandoned baby, which I would consider getting into as well. Look up here in the red. Bearish island reversal. We gap up, sideways, 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 gap down. That just absolutely nailed the top. So going forward, I'm going to be looking for either a bullish abandoned baby or a rejection of the 200-day moving average. It's had a huge sell-off, probably due for a bounce, but who knows? I need a legitimate signal before I would consider getting in. Coca-Cola. All right, Coca-Cola, you know, same thing. This thing just went straight up, and now things have changed. But we are coming to an interesting area. I don't talk about the 100-day moving average much, but here it is. This is the red line, the 100-day moving average. A really good confluence. This is a deep dip buy in a way. A really good confluence is when you get to the 100-day moving average and the 30 RSI. In order to do that, you have to have a really big sell-off. But look right here, we're at 29.49, so we're under the 30 RSI. We're right at the negative third ATR channel. One of the best confluences you can get is if you go under 30, over 30, at the same time you go under the 100-day moving average, above the 100-day moving average. So that is what I'm looking for. That's why I drew the green box here at the 100. Just an back over 30 RSI and not back over the 100, I don't think I would take the trade. But if we go from under 30, over 30, under the 100, over the 100, then I would potentially take the trade. And then my stop would simply be a close below the 30 RSI. So this would be a deep dip buy. Oh, and I should mention that in addition to the one-on-one course that I offer, I also have a really good online course available at udemy.com where this course is not all 7 of the trading approaches. That's just in the one-on-one course. But this online course on Udemy is the deep dip buy. It's 9.5 hours of video. It's a great course. I think I have like 4.8 or 4.9 stars on that course, and it's very affordable. It's somewhere between $30 and $50. You know, if you'd like to learn the deep dip buy, that is a great way to learn it. Like I said, it's 9.5 hours of video. It's 26 videos total, and I take you step by step on through the video course and teach you the deep dip buy, all the rules. And the link is in the description of this YouTube video to the Udemy course. So keep that in mind. So on Coca-Cola now, if we go back over the 30 RSI, go back over the 100-day moving average, that would be a good confluence. And we have had quite a big sell-off. Wouldn't be surprised to have some kind of bounce at this level. McDonald's. Okay, well, McDonald's had all that news, and we have earnings coming up on the 29th. But, you know, the only thing I'm looking for McDonald's is down here at the 200-day moving average. 200-day moving average is at 276.89. It's not even close. And very likely this is not going to happen. But with earnings, you never know. So if it does come down to the 200-day moving average after earnings, if earnings are bad or something like that, that's a pretty good place to buy. Way better than up here, right? And it gives you a good structure for the trade. Under the 200, I'm out. Over the 200, I could be in. So again, just a lesson in being patient, waiting for the level that makes sense to you to happen. We had the golden cross with the 50 crossing the 200. Remember, if you have a 50 crossing 200, the first pullback to the 200 is usually a pretty good bouncy area. So again, I don't know if it's going to get here. If it does, I'll consider taking the trade. If not, move on to something else. The Qs. All right, well, interestingly enough, we have a bearish order block. Look, here is your highest up bar close before market structure change. Market structure change here on Wednesday to the downside. And then we rallied, which often happens, back into the bearish order block. So I could have shorted here on Friday. I didn't short. I'm waiting for 497.20. Why that? Because it was a big down bar. If you go back to halfway the big down bar, that's usually where you will find resistance. So next week, if we head back up, reject that halfway, then I'll consider getting short. My stop would just be a close over the high, or in other words, all-time highs. So I didn't take it here. It's kind of too much range for me for a good risk to reward ratio. But if we do go back up higher, that will reduce my risk. And I'm waiting for a rejection of halfway there at 497.20. Silver. All right, silver. Well, this is an abandoned baby. We gap up. Everything's really good. We gap down. Not so good. Okay. Would it be legitimate to short right here and right now? Yes, it would, but I'm waiting for it to close the gap, the bottom of the abandoned baby, right there, 31.23. If it just keeps going down and I miss the trade, well, then that's all there is to it. But if we do go back up and reject the bottom of the abandoned baby, I will consider getting short there. I'll place a 2 ATR stop above, 4 ATR profit target below. Verizon, VZ. All right, so Verizon has had quite a sell-off here. This one's pretty simple. The 200-day moving average. I don't know if it's going to get there. If it does get there, I will consider taking the trade on a deep dip buy with the rejection of the 200. And that's about it. And by the way, if we get down there, we'll probably be at the 30 RSI. That would be a very good location to set up a trade. Doesn't mean it's going to be positive, but it gives you that 200-day moving average as your line in the sand. So it certainly could get there. And if it does get there, I will certainly consider taking the trade because I have that structure. But I'm in above the 200. I'm out below the 200. Walgreens, WBA. Okay. Well, Walgreens, you know, just I had a great trade on Walgreens. I can't remember where. Was it here? It was a few weeks ago. Oh, that's right. It was here. Under 30, over 30 on a deep dip buy with a double bottom bullish divergence. Nice trade, nice trade. I got out here before earnings, though, and then it raced up. But it's okay. It was still positive, but we had this huge move up, and now we have had quite a sell-off. But it makes sense. We've been so low. People took some profits. Well, here is your bullish order block from back here on the 3rd of October. The high was 869. The low was 852. This is the area that I would be looking to buy Walgreens, someplace between 869, 852. I don't know if we're going to get down that far. If we do, I will definitely consider taking the trade because this is where it bounced last time. Doesn't mean it has to bounce this time, but the chances are pretty good that it probably will. So that's what I'm waiting for. Pull back into the bullish fair value gap between 869 and 852. And last but not least, XLV. Wow, look at healthcare. Holy smokes. Straight up and straight down. Well, this one's pretty easy. 200-day moving average down here, everyone. The black line, if we got to the black line, we also have the 30 RSI that would come in, and that would give a good risk to reward ratio, very good structured trade with the 200-day moving average. So if it rejects the 200-day moving average, I consider getting long. I'll stay in it, follow my process unless it closes below, and at that point I'll just go ahead and get out. So those are the daily trades that I'm looking at. Let's quickly look at the weekly trades. I only have a couple of them. Adobe, I've been kind of stalking Adobe here for weeks and weeks and weeks, waiting for it to get to the area that I want it to, and it is almost there. We have a bullish fair value gap in the green, and then in the blue, this is the 250-day moving average. So the confluence would be that one, we're in a bullish fair value gap, and two, we are at a major moving average, which is the 250. And I said, if it comes back, if it gets down to that 250, that's the area that I would be looking to buy, and we're getting closer. I've talked about this for weeks. I mean, I think I started talking about it when it was here. And I said, if we go down to that 250, if and only if, then I would consider getting long there. So that's what I'm looking for, is a move down to the 250-week moving average at 472.68. Right now we're at 483.72. It could certainly get there. And then last but not least, Merck. Merck has just fallen off a freaking cliff here on the weeklies, but the 200-day moving average is coming into play. Now, earnings are next week. So with earnings, if the earnings are bad, it definitely could come down here. And if it does come down there after earnings, reject the 200, give me a good risk to reward ratio, then I would consider getting in the trade. So anyway, I hope these were helpful, everyone. If you have any questions about anything I discussed today, please feel free to put them in the comment section. I'll do my best to get back and reply to you. If you found anything of value today, I would really appreciate you hitting the thumbs up button. If you're interested in doing the 15-hour one-on-one course with me, just send me an email. Love to have you as a student. I will teach you everything you know. And usually if somebody sends me an email and says I'm interested in the lessons, I like to have just a free initial Skype call with them, just to get to know them, just to talk to them about their trading challenges, their trading goals, see if we're a good fit. And then after that call, there's never any sales pressure, I promise you. We just talk a little bit, get to know each other a little bit. Then when the call's finished, if you're interested after that, then you need to contact me again and say, okay, Greg, I liked what we talked about, and let's get started on the lessons. And like I said, I'd love to have you as a student. I'll teach you everything I know, and I every penny you spend on this will be money well spent. I promise you. Keep in mind, I have the Udemy course for the deep dip buy, and that's a great course as well. You're going to learn a lot there, and I just want to leave you off with hope you have a good weekend, and please try to go out and do something nice for somebody today. If we all did one nice thing for another human being, it would make the world a whole lot better place. If you could also go out and do one nice thing for an animal, I would really appreciate that as well. Animals, just like humans, appreciate acts of kindness, and it would just really make the world a better place. So thank you, everyone. God willing, I will see you next week. And again, if you have any questions, put them in the comment section. I'll do my best. But thanks a lot for your time, and if you've made it all the way through, appreciate that as well. Take care, everyone. Talk to you soon. Bye.
U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation, and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.